Hi, I'm Derek. I'm an Irish tax lawyer, and on here I give advice and tips about how tax works in the real world on the ground in Ireland. So I met a couple who used ChatGPT to plan their taxes and build an ocean view retirement villa in Portugal. It has turned into a financial disaster. They've doubled their tax bill and now their home is at risk. They moved to Portugal, signed up for a tax structure over there, got a tax number, filed forms, and genuinely believed Irish tax was gone. They started building their dream home. They had completed the paperwork. They were spending a lot of time in Portugal. So what went wrong? During our conversation, they proudly told me they were tax exempt, but they were a little stunned and annoyed when I explained that their worldwide income was still very much taxable in Ireland. They had assumed a person can only be resident in one country. They believed that by becoming resident in Portugal, they'd switched off their Irish residence and therefore Irish tax. They overlooked a basic point though. Irish tax law doesn't really care about the laws of Portugal or any other country. There are international treaties and case law. Those exist to prevent double taxation, but they don't help if Irish domestic law still applies. ChatGPT explained none of this. The couple built their home in Portugal with no tax planning. They put their retirement plans in the hands of an AI robot. Instead of avoiding tax, they have major tax problems and lots of stress. There's a tax relief for celiac disease that almost nobody claims. If you're celiac or raising a celiac child, you already know the cost of doing everything right. There is a tax relief designed to help with that cost. Now, people think celiac disease is about avoiding bread. They don't see the years of misdiagnosis. They don't see the blood tests, the exhaustion, the bloating, or the headaches. They don't see parents who spend years trying to understand why their child is sick. And they don't see adults who were dismissed for decades until the correct test was finally done. And when the diagnosis comes, that's only the beginning. Food bills increase by 30 to 50% overnight. Now, the state recognises that celiac disease is expensive. Because of that, there is a tax relief available. You can claim 20% back on the cost of gluten-free food and medical expenses connected with diagnosis and monitoring. Now you need to keep receipts and you need a letter from your doctor confirming the medical condition and dietary requirements. But with that, you can claim relief on gluten-free staples, specialist products, the additional cost of substitutes, diagnostic tests, blood tests, consultant visits, dietitian appointments, and related costs. Put simply, if you're incurring a cost because of celiac disease, it almost certainly qualifies. PAYE taxpayers claim relief through My Account. Self-assessed claim through their annual tax return. Receipts must be retained, but revenue monitoring of these is relatively light. A Dublin woman was hit with a €6,000 tax bill because of her husband's overseas employment. The couple maintained their marriage across two countries. The husband worked abroad and returned home weekly or fortnightly, when possible. Being married can reduce a couple's tax bill by almost €4,000 per year. Single individuals pay tax at 20% up to €44,000. Married couples with one income can earn €53,000 at 20%. That difference alone is worth around €1,800 per year. In addition, the married tax credit is double the single person's credit. Now, the wife had claimed those married reliefs. The issue arose when Revenue noticed that the husband was not returning any income. When asked, she couldn't prove how many days he was present in Ireland. Married tax credits require couples to be living together and Irish resident. So because she couldn't prove her husband's residence, Revenue treated her as a single person. They removed the married tax credit and the increased standard rate band. The result was a tax bill she didn't expect. It was triggered not by anything she actively did, but by the technicalities of her husband's work abroad. If you're selling your company and it has cash in the bank, you could be walking straight into a revenue tax trap. The portion of the sale price that relates to cash in the business can be taxed as income at over 52%. The situation arises frequently. A company has been profitable for years. Those profits have accumulated. They remain trapped inside the business. On a sale, the logic seems straightforward. If the business is worth €3 million and there's £500,000 in the bank, the agreed price becomes £3.5 million. That approach is often promoted by multiple uninformed advisors. Here's the problem. If the buyer uses the company's own cash to fund the purchase, once those funds are released, the seller is taxed on them as income, not capital gains. That means income tax at over 50% rather than capital gains tax, which may have been expected to be 10% or even 0. This trap applies to management buyouts and third-party sales, and many accountants and lawyers are just not alert to it. I've attended deals where months of work have been done, contracts prepared, and tax advice only sought at the end. At that point, the paperwork had to be torn up and redrafted. Those are the lucky cases. Some business owners only discover the issue when revenue intervenes. By then, there's no way back. Those were 4 different situations. The underlying issue is the same. Tax rules don't always work the way people expect them to. If you like this content, please subscribe, and you'll find more at taxunwrapped.ie.